Hey everyone, episode number 2 with Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. How about you?
I'm doing well. So one of the things that I think I might have gotten right is I think it was on the first or second of this year, I put out a note saying, hey, I'm watching the 10-year treasury. It was at 0.91. It's today, January 11th at 1.1. So that's a 20% move. I was talking with the mortgage broker Wednesday, Thursday last week, and rates went up an eighth of a point in 24 hours. So what I want to talk about is I think rates have bottomed. They're on the way up. We got trillions of dollars in new stimulus coming, both kind of life support and infrastructure. So lots of money being printed. I think rates go up from here. I think the 10-year could be at 2% by the end of the year. But what I wanted people to hear from this is you and I have invested in much higher interest rate environments, and you can do deals in higher interest rates. You don't need 30-year below 3% to do a deal.
Yeah, absolutely. I mean, when I bought my first house in 1990, just 30-year mortgages were in the 7.5, or maybe it was more like 9% or something. I can't remember, 7, 8, 9%, something like that. That was 30-year mortgages. And we bought them what's called a 3-2-1 buy down because our income wasn't high enough to qualify for a $120,000 house. That was what my first house I ever bought was. Great house, 2,600 square feet on a quarter-acre corner lot. It was beautiful for 120 grand. And, so we bought on a 3-2-1 buy down. The first year was not 7.75, then the second year, 8.75, third year, 9.75. And then in that 5-year period from 90 to 95, interest rates started dropping and the market was tanking, right? And real estate was bad news. So we ended up selling and then moving and then ended up on the Outer Banks. But I think we may have refinanced in there at 5.5, 6%, somewhere around there during that period. And then when I started building and developing, when I bought my, house on the Outer Banks and I moved there, I think interest rates were in the 5s, just below 6. And 30-year fixed, it was around 5.5 to 6%, somewhere around that, 97 to 2001 timeframe. But construction interest and investment property interest was huge. I mean, I was paying 9.75% interest on construction loans. Investment properties were in the 7s. The only thing that you could get, which is interesting when you compare it to today, were interest-only LIBOR loans. And those were the ones where you could get sub 5%, 5% or lower. And that's kind of where the best rates in the industry were. Today, they're in the 2s.
Yeah, it's amazing. And then really what I want people to realize here is, again, interest rates, the rise in interest rates may start slowly, but they can pop quickly. Right. I remember just go back to Greenspan. I think Greenspan, or maybe it was Bernanke. I think it might've been Bernanke. He raised interest rates like 17 times in 2.5 years.
Yeah. Greenspan, he was pre-2008-9. He's the one that single-handedly killed the real estate market in 2008-9 by shooting rates through the roof, and Bernanke came through and he kind of did the same thing. And, now anytime they try to raise rates, everything falls off a cliff, so in terms of the Fed rate, right. Now what mortgages are based on is treasuries. And the reason mortgages are based on treasuries is because it's a risk assessment. So investors are looking for yield and they're comparing what can I get for treasuries versus what can I get elsewhere, right? So that's why mortgages are based on that, mortgages versus treasuries, if I'm going to go in the mortgage-backed securities or am I going to go into treasuries? So that's why those rates are based on that to provide a spread for investors. And it can go up quick. And we saw it, 08, 09. I mean, rates shot up, the market tanked. We've seen it happen 2021 now. So 2020, end of 2018, 18. Rates almost hit 5% again and the market tanked. The fall of 2018, it fell off the cliff.
Yeah, I want people to remember that because a lot of people don't realize it. Yeah, the market. Who was it? It was Powell, right? No, who's the Fed chair now? Is it Powell?
Well, Powell is the Fed chair now. Mnuchin is the Treasury Secretary. So I don't remember when Powell took over, but I think it might have been him.
I think it was. I think it was right in his early days. He was trying to bring the market. He was trying to temper the market, and he raised rates twice in that last quarter, I think, of 18. And it did. It took not only the stock market, but it killed real estate, all the momentum, right? So again, interest rates, again, folks, interest rates will impact payment. People buy on payment. So I believe a rising interest rates environment may not do it at an eighth, but it rises 3/4, certainly a full percentage. We will see a pressure on housing prices.
So he took office in February of 2018.
Yep.
And so he created a problem towards the end of 2018. And when you go look that up, there was a lot of criticism about how he approached his position. And he actually came back later and had to apologize for his thesis on, how the Fed should operate and monetary policy and all that. And he actually flipped course 180%.
He's like, oops, that didn't work. That hurt. We got to go backwards. Oops.
Yeah. It's really interesting. Danielle DiMartino Booth, she talks a lot about when, he took over, because she has a relationship with him and, admires him, and, they work together at the Fed. And she talks a lot about when he took over and what he did from a policy standpoint, and how he totally flipped and had to come back and just say, hey, I messed up, man. That was the wrong approach.
Yeah. Yeah, again, folks, what I'm trying to get here is interest rates are likely to rise. We have lots of spending coming. The dollar is going to be impacted. People are going to want more for risk, but it will impact prices. It will impact owner occupants. But I believe a rising interest rate environment actually will create opportunities for investors, because we'll have all the competition from owner occupants, not all of it, much of it kind of pull back, I think.
Yeah, pay attention to the Fed, Treasury. Watch Treasury yields and interest rates, and be careful. And it's all relative. So back when rates were really high, prices were low, so it's all relative. Right now, prices are through the roof, but interest rates are low. Again, it's all about that monthly payment. That's how we, in the investment property world, that's how everything is based. Everything's based on the cash flow. Yeah. Which is that mortgage payment, at the end of the day. So same thing with cars. It's all about the financing. Every deal, and I made some videos lately about different degrees for millennials and college students. And if there's any college kids, millennials, anybody looking to go to college, that's in college, whatever, you're looking at graduate school, finance. Okay. Finance is the key to the deal. Without the financing, there is no deal. So you need to understand finance. You need to understand how to structure deals, financial engineering, financial architecture, deal structure, capital stack. You need to understand all of that. And how it comes to play, because without the money, there is no deal. The capital has the loudest voice. Yeah,
there you go. Well, again, folks, interest rates are rising. It doesn't mean we don't do deals. It will mean owner occupants have to pay more. It could impact prices. Again, I'm here to tell you, if interest rates go from 2.75, which I think is the average, or it's 2.86 or whatever it is, and they go to 6%, real estate will get hammered.
Try 4. I think 4 is the number now. It was, 04, 05. So remember where we came from. The 90s, early 90s, the market was sluggish. It started creeping up a little bit, but from 98, 97, 98, 99, that's when the boom started. Interest rates started dropping under 5%. So people were conditioned to think 7% was good. Then it was 6, then it was 5, and 5 was the magic number. And as long as we were under 5% through the early to mid 2000s, that was the peak of the real estate market before the crash. And anytime we tried to get close to or above 5%, the market would tail off. It would just stop. Mm-hmm. So then it became 4. Okay. And that's when Fed took over, 2018, and those rates started getting over 4, closer to 5, the market tanked. Now it's 4%. You get anywhere near 4%, done. Forget 6. You get anywhere near 4. You get into the 3s and you get close to 4, done. People won't buy.
There you go. It's going to be, and I guess I'll be on record. I think the 30-year gets it gets into the 3s. The question I have is, does it get over 3.5? I think it gets in the low 3s for sure. But
it's interesting. Our parents, your parents, my parents, they'll tell stories when they were buying double digits. Interest rates were 14, 15,
16. I think my parents told me, my mom told me, I think the first loan they had was like 16 and an eighth or something.
Yeah. But you could buy a house for 30 grand, 40 grand.
Yeah, exactly. There's a trade-off. All right, man. This is a lot of fun. Look forward to episode number 3.